Hello and welcome to Markets Today, the fear factor. Fear indeed it is. Indian rupee, stocks and bonds suffered one of their worst days in recent memory today. The warning bells rang overnight, with crude climbing $86 and the dollar index rising above 96. A strong dollar and strong crude is always a bad mix for India, but all of Asia and emerging markets have suffered in today's trade. Along with the Nifty, many indices like the Hang Seng and Kospi ended deep in the red, while rupee, not just the rupee, but several other Asian currencies also fell to new lows. My colleague Prashant is here with more bad news.
I mean, the US bond yield, Lata, rising to 3.2% was an added shock, making it attractive for long-term funds to flee to that country, that is the United States. The finance minister has tried to soften the impact of crude oil prices, the rising crude oil prices, but markets are still fragile and nervous. Today we have with us one of India's best known fund managers, one of the largest, who manages one of the largest funds in the country. Navneet Munot is CIO at SBI Mutual Fund, and he's with us here in our studios. Navneet, thanks very much for your time. Great to have you here.
Pleasure.
Which is the top worry for you out of all the litany of worries that we read out?
So there's so many of them to talk about. Globally, I think it's the monetary tightening, it's the rising crude oil prices, and the trade conflict. So of course we have seen some positive news on the trade war, particularly the pact with the Canada and Mexico. Maybe I think EU would be okay, but I think with the China it's going to be a tricky one. On the monetary policy unwinding, we were just discussing a few minutes before, the US Treasury yields are at a multi-year high. I think that will have some impact on all the other markets. Emerging market currencies and bonds are under pressure. And third, the rising crude oil price. From India's overall macro perspective, I think that's one of the biggest worry that we have at this moment.
Okay. Navneet, what the markets have undergone over the last few days, whether it is currency or equities or even bonds, is a waterfall. Now, what I wanted to ask you is, are we still to see more depths? Simply because, there are people who say that the US yields can go all the way to 3/4. I mean, we're already at 3.2. So 3/4 and 3.5 pretty quickly. It looked like a one-year call, but now it's happening probably in 2018 itself. So do we have more crunching falls to happen?
So US economy has been, both the US business and the policy cycle has been ahead of the G10. They've been doing pretty well relative to rest of the world, and they have been far earlier in terms of unwinding the monetary policy, the monetary accommodation. And I think the yields are heading higher, at least in the very near term, as the labor markets become tighter with the rising commodity prices and also the capacity utilization increasing. Fed will be on course to do a couple of more rate hikes. But remember that we are in the 9th year of expansion there. At some point in time, I think the economy will take the hit from rising bond yields, and maybe at that point in time, maybe the yields will get plateaued at some level. But at least in the near term, yields will keep rising. Now, from an India's perspective, if I look at, so US is at 3/4 and we are close to 8/4, 320 and 820. So that's 500 basis point. In last couple of years, since the time Indian inflation went up above 9%, I mean around 9-10% from 2009, 10, 11, if you see, they've been hovering around 500 to 700 basis point, the differential between India and US. But when Indian inflation was lower, if you see the 2001, 2, 3, 4, at one point in time in 2004, this was only 50 basis point, as low as 50 basis point. Okay. I think over the next few years, if the RBI remains very committed, and both the government, they remain very committed to the consumer price inflation target of 4%, then a 500 basis point yield differential should be okay. So let's say US goes to 3.5, we are almost there. But in the very short run, because of the concerns about the crude oil prices, what's happening in Indian financial markets, I mean, it can have maybe momentarily, I think we can move away from that, but otherwise I think we should be fine.
Okay. Navneet, do you think the RBI, and there is this in some sections of the market will respond with a 50 basis point hike? Do you think, and that may, I mean, it'll use that that interest rate defense. Do you think that is plausible, and what impact that will have further?
We'll know tomorrow. Of course, I think they would be worried about what's happening in other emerging markets, what's happening in other emerging market currencies, the contagion effect from the other emerging markets. They would also be worried about the rising crude oil prices and the pass-through of that in the domestic economy. Also, maybe the impact on the fiscal side, given that this is an election year. Having said that, I think having done 2 rate hikes, we are at 6.5%. If you look at the growth inflation dynamics, I think the case could be made for a 25 basis point rate hike, not a 50 basis point rate hike at this moment.
The CNBC TV 18 poll also threw up a 25 basis point rate hike expectation and change of stance from neutral to something else. But
I think neutral should be okay because it has to remain data dependent. We have to see how this liquidity tightening and some of the other concerns that we talked about, the repercussion on the growth also.
I'm coming to that. Yeah. See, the RBI seemed to have done, everything it could to unleash liquidity. But let me come to the growth question. Now, do you think we have to rethink our 7.4% GDP growth for the full year and our earnings growth? People already have started revising it from 18 to maybe 15. But could growth get impacted more because of crude and rates?
Simon, when you are paying higher prices for the crude oil, it's going from somebody's pocket. Now, if let's say government cuts the excise duty and takes the hit, government will be spending little less money on something else. So, of course, I think the money is going out of the country. To that extent, it impacts the growth, no doubt about it. Having said that, I think from the last year, some of the, whether it's for the demonetization or the GST, RERA, some of those kind of reforms, I think with the base effect turning positive, we saw a good number on the GDP side this quarter. I think over the next few quarters, our sense is that some of the other growth drivers, so let's say if the global economy is doing well, with now rupee weakening quite a bit, I think we have seen a 15% depreciation. Maybe exports, which have not been firing for last few years, starts firing a little bit. So maybe that cylinder will work. Consumption will get impacted because of the tight liquidity, and now also the with the challenges on the NBFC and the retail lending side. Investment spending, I think the oil's impact on the fiscal side, both the state and the central government, I think if the investment, because the government spending has been the main driver, government capex. Private capex, I think there are early signs, but I think that's a long haul. Maybe I think with capacity utilization increasing a little bit, maybe from next year onwards, post-election, 1920 would be the private capex story. So I think India is a bit tricky. I mean, you keep thinking that there's so many drivers here. Maybe on one side we'll have some challenges because of the crude oil.
Already we saw Royal Enfield numbers, rising only by 2%. The slowdown was already there, though of course, Hero Motor didn't show it as much. Do you think we have to therefore brace ourselves to more like a 14, 13 or 12% earnings growth and not necessarily 15? Therefore, the markets have to adjust both to an earnings and to a valuation crunch because yields are higher.
So you're right, because I mean last quarter was a very good quarter. You had, if I remember correctly, almost 17% EBITDA growth. But now with rupee weakening and commodity prices going up, I think there would be pressure on margins, particularly on the raw material side and also the rising interest cost. They will have some impact on the margins. Rupee is a tricky one. What happens that when rupee is weakening, there are part of market, exactly the IT exporters, I mean the healthcare, some of the other exporters like healthcare, and then the capital goods, engineering, etc. They will have some benefit on the margin side because of the weaker rupee. Overall, at least for the manufacturing segment, I think the higher raw material prices and rising interest costs will have some impact on the margins in the near term. And on the valuation, I think relative to the emerging markets, our premium has already gone up quite a bit because we are still outperforming the overall emerging market as an asset class, barring last few weeks, YTD as well as last 1 year. And the valuation premium has gone up quite a bit, and we must keep that in mind. And honestly, foreigners haven't sold much. YTD, FII outflow is only $2 billion in equity and $7 billion in fixed income. And then the valuation premium for India is high. So we must keep that fact in mind.
Navneet, in a way, the other shoe also dropped today. I'm talking about what the government announced earlier today, which with regards to oil. They are cutting excise by 1.5 rupees. They're asking oil marketing companies to absorb 1 rupee in terms of cost. Oil marketing companies sold off. The market also significantly sold off after that. While without talking about what happens to oil stocks or anything of that sort, but does it send a sort of adverse kind of signal? Because whatever you said about this government so far, at least this much you could say that they kind of sort of stuck with policies of deregulation, etc.
Extremely disciplined on the fiscal front. And last couple of days, I think they've clearly shown a determination to ensure that it doesn't lead to a contagion effect, whether the lower borrowing numbers, whether the decrease in the LCR by the central bank, whether the OMO announcements, and I think so far have been sticking on the fiscal deficit path. But of course, I mean, you have to see the political economy. I think if oil goes towards $90, I'm sure there would be other pockets from which you will have to extract some amount of money.
We're talking about 1 rupee. You've seen this over a period of the last many decades.
I just hope that
this is just 1 rupee and not more.
I just hope that it remains just 1 rupee, and then maybe market may take into stride. But I think so far a resilience has been shown over the last several quarters. I hope that continues. See, we must keep in mind that overall macro stability is one of the most important things, even for the growth in the longer run, even for the consumers. And that's why I think there is a need for maybe all of us and then policymakers to communicate this effectively to the end consumer also, that why this is important that these prices get passed through. If government is subsidizing it by 1 rupee or 2 rupee or 5 rupee, why it is not good for them in the long run.
Absolutely. No, I mean, I take that point that, both the interlocutors and the politicians have that role to play. But, time permitting, I'll come back to the macros. But we have to give some advice to people who are now watching. Now there is a large community in mutual funds. It's no longer a small elite who understand that, along with returns come risk. What would you tell that community? Just strap on your seatbelts and stay put, that after a year, a cheaper rupee will actually bring growth. What will your advice be to those who are invested in your mutual fund or in any of the equity mutual funds?
So I think, first of all, I think at least in the very near term, given the macro challenges that we discussed about, both from the global side as on the domestic side, will keep the markets very volatile. On top of that, you add the heavy political calendar over the next few months. So that will keep the market volatile. Now, volatility can work in both ways. Either you can take advantage of it or you can get swayed by it. My advice would be to investors, if you are a long-term investor, and one should only invest in equity if you are a long-term investor, then through the SIP, you are averaging it out, right? So the lower market for a long-term SIP investor is good. The markets like today, where the index fell by 800 or 900 points, is going to get more number of units.
Would it make sense to go to debt fund, duration or...
So as I mentioned that, whether the weak rupee or whether the RBI, the monetary tightening, whether the higher crude oil prices, the interest rates may move up a little bit. Having said that, I think time has come to look at SIP and fixed income funds also. In absolute terms, the yields are attractive. If you compare with the repo rate of 6.5% versus 8-quarter, if you compare with where the rest of the world is in Indian interest rates for a BBB- country, whichever way you look at it, and structurally, if the RBI is committed towards a 4% CPI inflation, I think if you are getting AAA bonds close to 9%, and one should start putting some money into the bond market as well.
What would you think will be the sector churn now? As a fund manager, how will you play through this volatile time? Would it be staples? Would it be IT?
The theoretical answer would be, the rupee is weakening, so let's look at IT, let's look at some of the exporters. If you think there are macro challenges, okay, let's look at staples. But I think it's a very nuanced answer. I would say that I think you have to look at what happens that when there is indiscriminate selling, which we are seeing in last few days, and looking at these macro challenges where both the retail investors the participation has come down significantly. The foreign investors may continue to sell for some time. At an individual stock level, you may see opportunities across the board, and that's what you need to keep focus on.
Okay. Well, I'm sorry I'm taking away the questions. See, what do you expect the yield will go to under the circumstances? Are you looking at 8-quarter only, or are you looking at 8.5? And if it were to go, say 8.3 or 8.4, Does that mean valuations can come down even further? Discounting has to be even more.
So of course, I mean, as Buffett says, that interest rates act as a gravity to all the valuation of all the other asset classes. If interest rates go up, they become relatively more attractive, then equity to that extent becomes less attractive. Having said that, so markets always move like a pendulum. They are never at a fair value. It's difficult to say that, okay, this is the likely inflation, this is where the repo rate will be, and this is where the 10-year should be. They always go to from one extreme to another extreme. Last year, we should not have gone to 6.10. We should not go where we may go in next few days, few weeks. I think given the news flow at this point in time from the rest of the world, maybe you will see some panic days. You may have a situation where the demand-supply dynamics will become more important than some of these fundamentals dictating the market. And in that situation, the best way to participate is over the next few months. If somebody does an SIP in fixed income funds, I think he will reap good rewards.
Okay.
Just a quick point on, you started with global markets and you said, well, money is moving back home and that's what's going on. All this is happening even as US markets and the S&P 500, for example, is looking extremely strong, right? I mean, and here there is mayhem. At some point, as you said, it's been a long cycle. Things will start to taper off there in some way. So what are we really looking at? I mean, what does it mean for the market here? Because there is always going to be the shadow of a nine-year-old cycle sort of tapering off at some point, and then that affects what happens here.
So of course, it's US where the cycle started. I think they were the most swift in terms of responding to the financial crisis. I think they repaired the balance sheet of the financial sector the fastest, and that's they recapitalized and then they moved the fastest. That's why they recovered the fastest. And of course, there is this innovation-led growth in the United States, and particularly what they have done on the technology side is just phenomenal. But we have seen that in some of the other economies as well. I think I'm a little worried about the trade conflict. We have to see in next few weeks and few months how the negotiation with China goes. So far, as I mentioned earlier, with Canada, Mexico, EU, they'll all be okay. But I think with the China, it's a bit tricky one. We have to wait and watch. We also have to wait and watch what happens in Italy in next few months, and whether the next crisis can come from the Eurozone. As of now, in the emerging markets, India is relatively doing better, actually. We give less credit to ourselves than what we should do. From a macro perspective, I think we are doing relatively better.
Okay. Well, before we let you go, Navneet, tell us, should we just brace ourselves for a 4-digit Nifty? Will that be around 9,000 that we can get away with? Will that be the worst?
I think in equity market, one should always be prepared for a 5-10% volatility here and there. And actually, if you look at the Nifty has done far better. Look at the stocks below the market.
Small caps are in bear terrain.
Yeah, lower the market capitalization curve. I think they have fallen much more.
Over 40% of all listed stocks are down over 60%.
So you would expect that to continue?
I think some amount of bottom fishing can be done in several of those names. Of course, one might say that given the macro challenges, one should stick with the large caps only. My sense is that we should look at the entire universe and you should try to find where the biggest gap is between the price and the value.
Well, those were the gems coming in from one of India's best-known fund managers, perhaps this is a time to also think of putting some money in fixed incomes, and yields are so attractive. And more importantly, maybe you have to look very closely at mid-caps as well, where there is a big divergence between price and value, some of them unnecessarily bashed up in this mayhem caused by higher crude prices and a stronger dollar. We have to take a break on that note. We're coming back and we'll wrap up for you the top headlines from Dalal Street today and get you some more market opinion.